The silver market is entering 2026 in an unusually fragile state, shaped less by outright scarcity and more by where metal is held and how easily it can move. According to a recent report from Goldman Sachs, thin inventories in key London vaults have left the market highly sensitive to capital flows, creating conditions in which prices can rise sharply and fall just as quickly. With silver now trading above $84 an ounce, the bank believes these structural imbalances could dominate price behavior in the months ahead. Goldman's analysis is notable for what it does not say. The bank is not warning of a global shortage of silver. Instead, it points to regional distortions and logistical bottlenecks that are enough to destabilize a market that is already more volatile than gold by nature. In this environment, traditional fundamentals such as mine supply and industrial demand may take a back seat to flows of metal and capital, making silver prices in 2026 unusually reactive and unpredictable. At the center of this dynamic is London, which plays a critical role in global silver pricing. London vaults underpin the reference price for physical silver and provide a large share of the market's liquidity. When inventories there are plentiful, shifts in demand can often be absorbed without dramatic price swings. But when stocks run low, even relatively modest changes in demand can have outsized effects. Goldman Sachs quantifies this sensitivity starkly. Under normal conditions, a weekly net increase in demand of around 1,000 tons might push silver prices up by roughly 2%. In the current environment, with London inventories depleted, the same level of demand could move prices by as much as 7%. That heightened responsiveness illustrates just how exposed the market has become to inflows and outflows, particularly from institutional investors and exchange-traded products. This imbalance also introduces what Goldman describes as an asymmetry in price behavior. When inventories are tight, rallies can accelerate rapidly as new buying absorbs the remaining available metal. But when bottlenecks ease or flows reverse, prices can retreat with equal speed. The result is a market prone to sharp swings in both directions, driven more by positioning and logistics than by changes in underlying supply and demand. The roots of today's tightness trace back largely to developments in 2025. Goldman notes that significant volumes of silver were moved into U.S. vaults as market participants sought to hedge against the risk of new tariffs or shifts in trade policy under the Trump administration. That precautionary behavior boosted inventories in American warehouses while draining availability in London, creating a geographic imbalance that continues to distort price formation. From a global perspective, there may be enough silver. From a pricing perspective, however, where that silver sits matters enormously. If metal is locked up in one region and cannot move freely to another, local shortages can emerge even in the absence of a true global deficit. This is precisely the situation Goldman believes is influencing today's silver market. Whether this imbalance corrects itself remains uncertain. Much depends on trade policy clarity. If concerns around tariffs fade and silver begins to migrate back from U.S. vaults to London, physical tightness could ease and price volatility might moderate. But Goldman cautions against assuming a quick normalization. The bank draws a parallel with the gold market, where large volumes shifted to New York COMEX vaults during tariff fears and largely stayed there, even after gold was exempted from tariffs. If silver follows a similar path, inventories may remain regionally concentrated even after policy clarity emerges. In that case, the market's heightened sensitivity to flows could persist, prolonging the current phase of sharp and sometimes abrupt price movements. Despite record prices, Goldman does not see evidence that silver demand is fundamentally overstretched. One key indicator is holdings in silver-backed exchange-traded funds, which remain below their 2021 peaks. This suggests there is still room for additional investment demand to enter the market, particularly if interest rates decline further or if investors seek broader diversification amid macroeconomic uncertainty. That potential creates another layer of complexity. In a market with thin available inventories, renewed ETF inflows could amplify price moves far more than they would under normal conditions. What might once have been a gradual rise could now become a rapid surge, reinforcing silver's reputation as a metal capable of dramatic momentum-driven rallies. Adding to the uncertainty is a new development from Asia. China has introduced export restrictions for 2026 that require official approval for silver shipments. Goldman does not interpret this as a trigger for a global shortage, but it does see a risk of further market fragmentation. If silver can no longer flow freely between regions, liquidity declines and local bottlenecks become more influential in setting prices. This, according to the bank, points to a possible structural shift in how the silver market functions. Instead of a largely pooled global system, where inventories in one region can offset shortages in another, market participants may increasingly build and rely on their own regional safety stocks. Such a shift would reduce the market's natural buffering capacity, leading to higher premiums in tight locations and more erratic price behavior overall. In this fragmented environment, price discovery becomes less efficient. Physical markets may begin to decouple. with regional premiums reflecting local conditions rather than global fundamentals. For investors and industrial users alike, this could mean higher hedging costs, greater uncertainty, and more frequent price dislocations. Taken together, Goldman Sachs' assessment paints a picture of a silver market in 2026, defined less by the question of whether there is enough silver in the world and more by where it is located and how quickly it can move. Tight London inventories, lingering trade policy uncertainty, and new restrictions on global flows have combined to create a market unusually prone to sharp swings. For investors, the implication is clear. Silver's price behavior in the year ahead is likely to be driven as much by positioning, logistics, and capital flows as by mine output or industrial demand. In such an environment, rallies can extend further than expected, and reversals can arrive just as suddenly. Even without a permanent global supply problem, silver remains uniquely exposed to rapid changes in direction, making 2026 a year in which volatility, rather than scarcity, may be the defining feature of the market.